if you want to increase supply, you shouldn't be reducing the CGT exemption, right? If anything, there should be more of a benefit for investors to help supply side. What it of course does is it increases revenue for the government and it offsets some of the debt they have. So it's the same solution to two different problems, which are basically pulling the budget in different directions.
And investors will find ways to invest, like knockdown rebuilds will be a big part later on in investment.
Yes.
The home and land packages and the off-the-plan units and all suddenly can have good days because of negative gearing limited to brand new properties. Hello everyone and welcome to another episode of Building Generational Wealth through Strategic Property Investment. I'm your co-host Sandeep Jagtap, Director at FinSource Mortgage and Finance Brokers. And along with me, I've got my co-host George Churchian, Founder and Director at James Chase Bias Advocacy. Welcome George, and how are you doing?
G'day Sandeep, I'm very well. How are you?
Good man, good. Excited, a lot of changes happening around us. The budget coming up and a lot of maybe discussions, noise and rumors floating around. So yeah, good to dive a little bit deep into it and see what it means for investors.
Absolutely. I think May is going to be a very interesting month. So everyone I speak to are watching two critical dates, one being the interest rate announcement and then shortly followed by the budget. So
Yeah.
a lot to unpack there.
Yeah, absolutely. So before we go ahead, just a disclaimer, this is not financial, accounting or legal advice. We are discussing our experiences, our knowledge we have gained through the industry over the number of years. So please do not treat this as financial advice and act on anything we discuss here without getting proper financial or accounting advice. So let's get started, George. So yes, May is going to be an interesting month, you said. And the budget, the RBI interest rate decision. The RBI interest rate decision is key because of the inflationary pressures being as they were, a little bit pressure on the economy as such because of the international unrest or the wars happening and the oil supplies being limited, and which is percolating to everything into day-to-day life.
Certainly, it's very much got a very big knock-on effect, right? So when you look at global supply chain, it impacts not only what we pay at the pump, but also food, beverage, everyday living. So the impact is tremendous.
Yeah, so that's where it will be interesting to see what RBI does when it meets again in May. Some lenders, major lenders, their predictions have been we may not have a interest rate rise in May.
Mm-hmm.
But we may have one before the financial year ends. So probably
next
in
month.
June. And there may be one more in the early parts of the next financial year. So but who knows? It's a long game at the moment. Things are changing rapidly in the Middle East and the situation is volatile. So RBI has to adjust to what is happening around the world and how it is affecting day-to-day Australians.
Certainly. And if I'm not mistaken, I guess one or two more rate rises brings us back to the COVID peak, doesn't it?
Just past the previous peak because we are just one interest rate rise below the previous peak we had post-COVID. So if we have two, that would probably be 0.25% higher than what we were before the 3 interest rate cuts we had.
And I think it's very interesting to see the psychological effect of that, to be honest, because we do as a market react quite strongly or adversely to the RBA rate rises, and the psychological effect of it very much does tend to come into play.
Yeah, I agree, George. And one more thing I would probably think of is, when we had all those 13 and 14 interest rate rises, the property market kept going.
Yes.
We didn't see corrections. We actually saw 12 and 15% growth in states like Western Australia and Queensland and South Australia. So
I do recall.
it's the real demand supply equation here, which drives the property prices, and the interest rate rises. People know that these interest rate rises will be there, but the people who can manage their cash flow efficiently and have their strategies sorted out would still keep on investing or are still investing as we speak.
I believe so. The behavioral aspect of it is quite fascinating because, we touched on COVID and the same thing happened there. We went through a series of rate rises. People paused and they waited, much like they're doing now. But then if the condition in COVID at that time goes on for long enough, unfortunately, and it doesn't sound nice, it becomes the new norm, and then people get on with the decisions they need to make. So there was a big flurry, a lot of investors going into the market at that time, and I dare say it will probably be the same second half of this year.
Yeah. So look, that's where the interest rate situation is. Let's see what happens when the RBI meets again. That's one thing. And the second thing is the 12th May federal budget, George.
Yes.
So a lot have been talked about how property investors are going to be affected as a result of the measures the government is thinking of in this federal budget. And that sort of, has people talking, saying what next for property investing.
Certainly. I actually think this is probably the most highly anticipated budget in probably the last decade. So there's a lot of conversation around changes to CGT and negative gearing, and I know we're going to unpack some of that. So it's highly anticipated, that's for sure.
And last time, I think when it was Bill Shorten, the opposition leader under whom the Labour went to elections, and there was that discussion about the same lines, and that was partly to blame for Labour's surprising loss in the elections.
Yes.
But now they are in, and they are thinking of making that decision. So yeah, it looks like it's happening in some shape or form.
Yeah, I think so. It'll be interesting to see where it lands, and hopefully there's some future proofing and not just a short-term band-aid in what we're seeing, because ultimately it does go off. The Parliament and the government hedges off votes, and it needs to be something that's sustainable, something that's long-term, not just a short-term knee-jerk reaction. Let's see.
Yes. So correct me if I'm wrong, George. So there are two things at play here. So the capital gains discount, long-term, if you hold for property for over 12 months, you get a 50% discount in the CGT when you sell it. If it's an investment property, they are thinking of getting it to 25 to 33%, or even to the pre-1999 regime where it is adjusted to the CPI inflation. Is that?
That's my understanding as well, absolutely. And, when you look at 50% change to 25 or 33%, on a percentage basis, that's quite a big reduction, right? So it's easy to understand why people are put off by a change like that or concerned by it. But when you apply some numbers to it, the change isn't actually all that big. And then, of course, over the last several weeks, the conversation around going back to the pre-1999 indexation model, where it's essentially hedged against inflation or CPI, that discussion has started to get some traction as well. So once again, I don't necessarily believe it's going to be all that bad, even with the indexation model, because it kind of takes the steam out of the whole incentive, in my view.
And generally, when the government changes this type of policy, there is some sort of grandfathering there. So properties being purchased before this announcement may not be affected.
Yes.
And the properties purchased after this budget would probably be subject to those sort of changes. However, we don't know whether the government will grandfather it or not. It only remains to be seen.
Certainly. And then the other observation, I guess, is the different asset classes in real estate as well. So typically, commercial real estate has sat outside of these sorts of policies. So again, it would be interesting, given obviously the uptake of commercial real estate investment, whether that is included or excluded in the policy.
Yeah, and that will probably, when the government announces it and in what shape or form they announce it and what are the timelines and what sort of properties get excluded from that, will have some sort of short-term impact in the property market.
100% it will. It always does. So there's an initial ripple effect or an initial impact, and then investors tend to evaluate and then move forward. One thing's for certain, I guess, any cost impact that is coming towards an investor, then there's of course a knock-on effect to the tenant at the end, unfortunately.
So if it is grandfathered, then people holding those properties, investment properties in their portfolio, may still enjoy the benefit of that 50% discount. But if it is not grandfathered, then there should be some short-term supply in the market or some sort of exits from certain investors. And that this policy, coupled with the other one, with the negative gearing changes, limiting to 2 properties and only available for the newly built properties. So if those investors who have more than that number of properties, established properties, And would they be affected? And if they are affected, then would they come to the market with their properties if they are not going to get that benefit by our incentive for holding that property?
For grandfathering, absolutely. It'll be really fascinating to see what happens in regards to that element, because I can see why they would want to grandfather it. It's almost, the right thing to do or the responsible thing to do. But also conversely, it kind of takes away the sting of the whole incentive, if I'm honest with you, because ultimately what you're saying is if someone has 10, 15, 20 or a larger portfolio of properties, then it's through those people where the government is going to see the revenue. So ultimately, it's going to do one of two things. They're either going to grandfather it, and those people will shift their attention into other investment activities where this tax isn't an issue, or they're going to not grandfather it, and these people are either going to basically dump their product or find a way to recoup their cost.
And why are they trying to do it? To sort of have more of an opportunity or incentive for the home ownership, like
Agreed.
That will reduce the competition for the established properties between the investors and the home occupiers.
Yes.
And that's where I think they are trying to make sure they incentivize the home occupation.
Yes.
And that's where they see the study from the if you look at what they are saying is it will affect if I look at some numbers, it will affect about the property prices by about 4% in the short term.
Which is nothing, right?
Which is nothing, because even during COVID and during the interest rate rise periods, property has grown 10%.
Yes. Yeah.
Nationally.
Yes.
So not going to do much is what it's the study shows. However, it is going to affect the rental market as such, because if there is no incentive for investors to buy properties to rent out, that's where the rents will be under stress, rents will rise.
Yes.
And we are already in a difficult situation in certain states where there are not enough properties to rent.
Agreed completely. And I think what this is ultimately doing is the intention behind it all is to create a level of equality. It's to allow the current generation or future generations to be able to own a piece of the Australian dream. So find your home, buy a home, have that ownership as, their generations before them did. However, in my view and based off what I see, it's creating a bit of a separation. So you've got quite a few of the affluent areas where a lot of the development is actually happening, and you're seeing $3, $4, $5, $6 million penthouses coming out of the ground now. But that's not where the supply is needed. So we need the supply in blue collar areas where people are struggling to afford to buy a new home. But ultimately, again, my personal view is that these incentives will have a short-term impact. There'd be a level of investor activity pausing or slowing down. But I struggle to sort of reconcile how it would benefit the home buyer at this stage.
Look, it remains to be seen, and we'll only see a year down the line or a couple of years down the line how this has really helped, and is that the right move in what the government is thinking to do?
So a lot of the policies are designed around essentially tempering the demand side of the equation, where we really, I believe, need to be looking at the supply side. So ultimately,
we're not building fast enough.
We're not building fast enough. We're not incentivizing builders to build fast enough. And we seem to be, as a government, wanting to tax every element along the way. So if you look at the amount of taxes in a new development, for example, if that's somewhat tempered or removed or paused temporarily, it starts to make some of these projects more viable, especially in the areas that need them, like your Western Sydneys of the world. So the other element is, of course, again, over the last several years, the empty nester terminology, where people who are older, they've upcycled over the years into a nice big 4 or 5 bedroom home, 2 stories, 3 bathrooms. They've got grown children, they've got grandchildren who've left the home, but now they've got a debt-free or close to a debt-free property larger than their needs. However, those people will not do anything because 1, they're already debt-free, they've paid down the house. 2, if they were to buy another property, then they're going to be having to have to pay stamp duty, right? So, and a lot of the time that's going to eat into their retirement savings, or they just don't have the money to do it. So, an interesting concept I heard recently, we obviously have the first home buyer incentives designed to try and help those first home buyers into the market. And you could argue it's kind of had the adverse effect. But a concept of a last home buyer. So it's actually
that's interesting.
It is very interesting. I actually sort of read it and I thought, you don't often read something that actually makes a lot of sense. So it's obviously not a formal government policy or a framework, but it's more of an idea that is being circulated through some economists, where if you want the empty nesters to downsell their property, then you could apply a framework to that and have some sort of formal application process that is audited. So if you have your 5-bedroom, 3-bathroom home and you want to downsize into an apartment, then the stamp duty element, essentially the payment would be taken away. So you'd go through checks and balances, and the real incentive is, yes, we're happy to downsell our place, but we don't want to pay this tax.
And that will bring some properties in the market.
Of course.
Where they would downsize and that will also have them those funds for their retirement. So I think that's a great move if it happens.
It creates a lot of buffer. To me, it makes a lot of sense. And of course, the government still makes their incentive or the stamp duty revenue when someone buys the house they've just vacated or put on the market. So it's not about completely shutting them out, but it's sort of saying, well, yes, we want you to do this. How can we make it easier for you? How can we make that decision easier for you? So I'd like to see something like that get some more traction.
That's really great. Let's see if we hear more about it going forward. However, coming back to our discussion about what happens if the CGT discount is abolished or toned down a bit, and what happens if negative gearing is limited to 2 established investment properties. I think that's a key one more than anything else. Because if, say, I've got 7 or 8 investment properties and only 2 of my properties qualify for the negative gearing, then suddenly my taxable income rises and I am supposed to pay more tax.
Yes.
In that case, there is no incentive for me to sort of have those properties. So there will be certain investors who may bring their properties to market and sort of get rid of it.
Yeah, I think so. And personally, again, I'm not worried, but I'm probably observing that one a lot closer than what I am the CGT changes, because I think one way or another that's going to be much of a muchness, if I'm honest. So I don't think that will deter investors so much once some time has passed. But certainly going from having, I guess, a neutral impact to tax to now all of a sudden quite a different one, depending on the size of one's portfolio, it takes away every incentive, right? So as investors, what we do is typically look at the scenario, assess it, and if it's no longer viable, you look at pivoting. So that could certainly increase supply. However, again, from an affordability perspective, I'd question whether it will get the outcome that it's designed to.
Yeah, and some interesting data I found out as well. And in 22-23, 37% of rental deductions went to 500,000 landlords in the top 10% of income earners, and about 71% were claimed by top 30% of income earners. So 1 in 5 income earners in the top tax bracket reported rental losses compared to just 6% in the lower tax bracket. So there are definitely professional investors or seasoned investors who have had their property building strategies, and they have acquired properties, and that's how they've been claiming those deductions every year, and that's an incentive.
They've been negative gearing it off the advice of their accountant or advisor, what have you. Yeah. So I actually think it will be really fascinating to see the impact of that. Again, both the immediate psychological impact, but also the long-term aspect as well. But when you sort of counter it again with things like migration and the type of migration that we are currently supporting, there's going to, if those investors dump that supply, there's going to be people there to absorb it, I think.
Yeah, and if the CGT discount is sort of, say, goes to 33% or 25% or gets adjusted to CPI, then the investing will change. I don't see a panic in the markets. Like I won't see the property market crash, as they say, or a lot of videos you can see these days saying the property market crash is coming and this and that. And I'm not really worried because the fundamentals of the Australian property markets are strong.
Yes.
There is great demand. We don't have enough properties to rent. And the migration is increasing.
Yes, certainly it is, yeah. And I tend to believe the strategy will change. So ultimately, if the change in policy or tax reform puts an investor in a position where they're going to be taxed more for holding property and the negative gearing is going to be going away, then the counter move to that is look for investments that are more cash flow positive, right?
From capital growth, the strategy would change to great yields.
Great yields. And ultimately, when you look at it, why do we invest anyway, right? So yes, we invest for capital growth in the short term, but the end goal is cash flow. So if there's a way to accelerate that or reprioritize, I guess, the steps that an investor goes through because there's some hurdles along the way, then the strategy might shift. So instead of long-term capital growth, then eventually cash flow, it might be a case where, well, how can I fund the acquisition of a block of units, or how can I fund the acquisition of a commercial property that will yield something that's higher than the interest rate?
Yeah, and one more thing which probably comes to my mind in these discussions is people have bought properties in Western Australia, South Australia and Queensland, which have grown significantly over the past 5, 6, 7 years.
Yes.
How are they going to be affected if it's not grandfathered and people having significant capital gains in these sort of states?
It'll definitely be something to watch. Definitely. I tend to think the grandfathering will come in, is my personal sort of opinion, because one, it's kind of the right thing to do and have a deadline of when the new policy will take effect from. And that's fairly consistent when there has been policy change. So there would be a point of, I guess, commencement for the new change.
Yeah, and that's why I don't think investors need to be worried at this stage until the government makes those announcements and we see the details of what the policy change looks like. Because there's so much, we are getting so many questions at the moment. People are nervous, people are worried, some of them are panicking. And it's a point that it's only 15 days away now.
Yeah, I agree. And the thing is, to some extent, there's nothing you could do about it as an individual, right? So my philosophy on that is, if there is a change, as an investor, you assess that change and you provide a response. Because ultimately, we are very much in the driver's seat. So if my current strategy becomes ineffective due to policy change, then I need to review my strategy. And that's something we would do regardless, right? Whether or not there is a policy change. So it's about understanding the impact, but then coming up with an appropriate response that doesn't disadvantage us.
And even the government, when they make these changes, they would be mindful of these, because if it shifts too much, we've seen what the Victorian market has done in the past few years because of the land tax.
Yes.
Because the government not incentivizing the investors to invest in Victoria. Have you seen Queensland gone past median price of Victoria, and we've seen that with Western Australia. Yes. And Melbourne is probably the second biggest city in Australia after Sydney. So having too much of a policy at the other end can have effect on the property markets. So it's what they're trying to achieve. And if they go too much in the other direction, it may sort of create a bit of a inconsistency in this, and that probably would deter investors from investing, and that would have less properties on the market for renters, and that means higher rents for anybody who wants to rent.
Yeah, agree. I think, again, because going back to the supply issue, there is no incoming supply. It's minimal. It's nowhere near the level that we need. And unless there's a wholesale change to supply, I think all of these policies will probably have a minimal impact, other than something quite aggressive like what the Victorians have done.
And one other thing which is in play at the moment and which is not talked enough about is the increasing cost of construction.
Yes.
At the moment, due to the conflicts in the Middle East, the logistics is a problem, and shortfall of construction supplies and the high prices for the same equipment or material to build. So what we have seen during COVID is the material costs went up during COVID, they never came down significantly. And so what happens now? Will the construction costs increase because of the increasing cost of materials in this range of maybe 20-25%?
Yeah, I think that's an interesting piece too, because again, we're not constructing anywhere near enough in terms of the network I speak with. Developers, builders look at opportunities through a fine-tooth comb before they commit to it, before they determine it's viable or not. I think long-term, that probably gives way to a different type of housing as well. So at the moment, it's traditional construction. It's, bricks and mortar or cladding or what have you. But there's an argument, and there has been for quite some time, for prefabricated modular homes. And I know that there are organizations and bodies where these products are imported, they're tested, they're deployed in some regional areas for tiny homes and things of that nature. But you don't see it as a wholesale solution in a metropolitan city. So if the cost of construction keeps rising, and yes, we need more supply, then there needs to be some serious consideration to an alternative way of delivering that.
Yeah, and that's where I think as an investor, so you own a property portfolio, I own a property portfolio. So how am I looking at it, George, is take stock, just wait and see what happens at the budget. When it is presented, what are the timelines based on the budget? What happens to my existing portfolio? How does that change my investment strategy going forward? Sit down with my financial planner and accountant, see what the implications are for me as an investor, and make a decision based on that. Like, no need to panic, just take stock.
Yes.
Do your numbers. Don't try to do your numbers yourself. Seek help of your professional accountant and understand what it means.
Absolutely. I think that's sage advice, Sandeep. Because there's no point in having a knee-jerk response to something. It would take 3 to 6 months for these things to play out. And there's a version of it where a policy is announced, but government doesn't follow through, to be honest. And we've seen that on a couple of occasions. Once more recently with Queensland and their proposed land tax calculation, right? So eventually they proposed to essentially charge land tax based on one's national real estate holdings. And 11th hour, they moved away from that. So if there are investors who reacted prematurely and essentially divested a whole lot of real estate, then in hindsight, they would have done that in vain. So again, take stock, understand it, as you suggested, get some counsel from your advisor, your accountant, and then come up with a strategy that's suited to you.
And if you look at the history of land tax, it first started in September 1985, and John Howard government changed it in 1999. So since then, the current regime has been there. So pre-1999, it used to be adjusted to CPI. And after 1999, to incentivize the investors to invest and to provide for rental properties, the government came up with 50% discount on CGT. And with this change, we may go to something pre-1999 or some sort of a hybrid model where properties are taxed somewhere in the middle, something of a hybrid model, 25%, 33% or CPI indexation remains to be seen. But to be honest with you, if I think as an investor, I'm not really thinking that it's going to affect too much.
No. And as you say that, Sandeep, a thought creeps in. I think, there are two key issues here. One is the budget itself and the fact that we're over $1 trillion in debt. So that's one problem that the government's trying to solve. But they're trying to use the same solution to solve the housing crisis. So if you sort of think about it based off what you were just saying, if you want to increase supply, then you shouldn't be reducing the CGT exemption, right? If anything, there should be more of a benefit for investors to help supply side. But what it, of course, does is it increases revenue for the government and it offsets some of the debt they have. So it's the same solution to two different problems, which are basically pulling the budget in different directions.
And investors will find ways to invest, like knockdown rebuilds will be a big part later on in investment.
Yes.
The home and land packages and the off-the-plan units and all suddenly can have good days because of negative gearing limited to brand new properties.
Yeah, Yeah, absolutely. So that'll definitely take off. And I can see, again, the pros of that sort of approach too, because ultimately, if we are saying the capitals are becoming too expensive, where are they going to provide those incentives for house and land? They're not going to be in the capitals. They're going to be slightly removed. So it basically just pushes the population out and spreads it out geographically.
And that will create that competition for the home occupier in the new property space, but that should relieve the pressures on the existing properties. So,
yes.
Give and take on both sides really, but to be fair, it's not going to be. I've seen some videos sent to me saying, we'll see the property market crash by 30%. And I'm thinking the numbers don't add up.
Yeah, I didn't see that happening at all in the foreseeable future, to be honest. Yeah, the fundamentals are too strong.
Fundamentals are too strong, and the entry-level properties, the properties under $1 million or up to 1.5 million, there's always demand there.
Yeah.
People want to buy.
Yeah.
People were priced out in the market.
Absolutely. And if you think about a 30% reduction too, that has impact to the big lenders as well, right? So in terms of liquidity scenarios for them, in terms of LMI events, etc. So I think, a 30% reduction, it would take something really, really drastic and unfortunate for that.
And when it comes to lending as well, at the moment, if you look at the lending for investors, a lot of banks would look at negative gearing in the servicing calculations.
Yes.
And that will mean people would not be able to borrow more if that sort of situation changes with negative gearing limited to 2 properties. However, remains to be seen if a couple buying properties, how that's going to affect. I myself have got no clue about it, but if I buy 3 properties and my wife buys 3 properties, are we both with the property ownership? That is how it should be.
Yeah.
Right?
Yeah.
But it's a good time to sit down with Mr. Accountant after the lid is off, and we need to see how it affects our existing portfolio, how it affects how we invest going forward. We'll keep investing. Investors will keep investing. It is just that strategies will change. Type of properties they buy would probably change, and the focus would change probably in the short term from capital growth to yield and good cash flow properties, because then they have to service the debt as well.
So perhaps post-budget we can have one of our accountant colleagues come online and help us unpack it.
Digress it a bit, and we'll sit down with our accountant and see what it means for investors. So that definitely would be a good idea post-budget. Now when we are recording, we are about 2 weeks, less than 2 weeks away from the budget. But really exciting time. I'm personally not worried about it. No. I'm cautious. I'm going to watch it closely, what it means for me, my investor clients, and investment as such going forward. So honestly speaking, it's just wait and watch.
Yes.
Don't panic. Things will happen. In the short term, things will happen. And it's not going to be ongoing panic, and things will change, and the market will reset itself, and the journey should continue. That's what my thinking around this is, because not a single policy change has created something really crazy in the markets in the past too. So
completely agree, Sandeep. Yeah.
And that's where, just sit back, just revisit. Accountant's advice is going to be key going forward, understanding what it means. Just do your numbers, do your mathematics, and then think what you need to do.
We'll go from there. Absolutely.
Thanks, Josh. That was look. We still have a lot to discuss about this, but we just have to wait and watch. And post the budget, we will get one of our accountant friends to join us in this podcast, and we will find out more on how it affects and what's going to be the investment game going forward.
Look forward to dissecting it all with you, Sandeep, post the budget.
Thanks, George, and see you next time.
Thank you.
Thanks everyone for tuning in, and let's come up with next a new topic in the next episode, and we'll see you then next. Thank you.